Hey all, so the other week the UK government cut interest rates to 0.1%. In this video I'm going to be telling you why the government have cut rates, what they think is going to happen, what I think of this decision and the impact that it will have on the property market and the wider stock market. So let's get into the video. Firstly, just a quick disclaimer for anyone new to the channel that might be asking what is interest and what is the UK base rate. Interest is what's typically charged on a loan or a mortgage. This can take two forms usually, either fixed interest or base rate plus X%. For example, if you take out a mortgage, it might be at base rate plus 1% or base rate plus 1.5%. Base rate is the UK bank's interest rate that tracks the general economy. It's recently been 0.75% for quite some time and 0.5% before that, but it's recently been cut to 0.1%, which is a huge drop. So why have the UK government cut interest rates? Interest rates are cut to spur on investment and borrowing. If businesses continue to invest, it will continue to grow the economy. By investing, businesses will open new stores and employ more people, which will keep people in jobs for longer and create more jobs for the economy. It will also help calm fears of recession, as rate cuts are often used to combat recession. It will also encourage people to continue spending and to continue buying things to support businesses in the country. So what do I think of the decision? Well, I think they've cut rates too early. Back in 2008, Bear Stearns collapsed in March. The housing and economy recovery started in around July and Lehman collapsed in September. Therefore, it was around 4 to 5 months until the government actually cut rates, as they didn't cut rates until November-December time, which is obviously 4 or 5 months since July. In 2020, the global illness started in late December, early January. The UK government started to react in February, but by cutting rates in March, I think it's just far too early, as they haven't given enough time for the situation to develop, the illness to start to subside, and then cut rates to spur on the investment. I currently think that at the moment, no businesses are really looking to start investing. Businesses are currently looking to save cash because obviously cash is king. Because of the closure of restaurants, pubs and gyms across the UK, I think a lot of businesses are going to be preparing for a number of period of months with zero turnover and are therefore going to be looking to save cash and not make investments. I think businesses at the moment are currently analysing just how long they can survive with zero sales. There are some businesses out there that have, say, £10 million in the bank, but an annual expenditure of only £2 million. Therefore, these companies can survive for about 5 years with zero sales. But there are also some companies out there that have £10 million in the bank, but an annual expenditure of about £100 million. Therefore, these companies can only survive for about a month and a half before they run out of cash. As a few examples, Boeing have just drawn out $13.8 billion in cash, because obviously they might not have enough. Hilton Hotels, the big group, have just drawn out $1.75 billion, because obviously they might not have enough to keep going. And AB InBev, the company behind the likes of Stella and Bud Light and Budweiser, have just drawn out $8 billion to be able to see off the next few months with zero sales. I'd also play devil's advocate and say as far as that cutting rates doesn't calm people's fears about recession. In fact, it probably increases fears about recession, because obviously the people are going to recognise that the government are doing something about it, showing that the government are scared and preparing for a recession. However, I personally don't think that the worldwide illness could cause a recession. A recession is determined as 2 straight quarters of continued GDP relaxation or shrinkage, which means basically that the economy hasn't improved for 2 straight quarters. The reason I believe this is that I think we should look towards China for an example. China have currently been in countrywide lockdown for 2 months so far, and actually their countrywide lockdown has just ended. The infection spread rates in China have massively reduced over the past few days, and therefore they think that they're over the worst of the infection and allowed back to everyday life. Therefore, I think that the global illness is going to last potentially 2 to 3 months. How will the rate cut impact the UK stock market? I think that at the moment the market is too volatile. Over the past few weeks there have been numerous days with a greater than 5% movement on day-to-day trading. Therefore, I think that any rate cut won't have a meaningful impression on the stock market. However, going forward, I think that in the future this rate cut will have a very positive impact on the market. Because the government have been very proactive in helping out the regular people and not just saving the big banks like in 2008, by creating a £330 billion loan package and continuing to support and pay 80% of salaries to workers, I think the market will react very positively. Also, at the moment, I think that it's a great time to invest. Will the stock market continue to fall? Maybe. But can you pick up some stocks at a 30% discount or a 75% discount for some specific stocks? Absolutely. You can continue to wait for the stock market to continue falling to maybe say you get a 40% discount or an 85% discount on those specific stocks. But it's probably better to lock in some discounts at the moment and pick up some stocks now at a great price. Now, what do I mean by discounts exactly? There are a lot of companies that over the years have continued to perform well, such as Coca-Cola or Apple or BP. These companies are on quite significant discount at the moment, say 30% down from their usual trading price. Therefore, it's a great time to pick up some stock because it's likely that going forward into the future, these companies will replicate what they've done over the past tens or hundreds of years in some instances. However, I think it's also very much worth considering your own situation at the moment. If you're currently working paycheck to paycheck, I probably wouldn't advise investing at the moment, as there's a lot of uncertainty in the market and a lot of businesses are closing and pausing staff and not paying salaries and potentially dismissing or getting rid of staff at the moment. Therefore, you don't really know if you're going to have a job at the moment. But if you do have quite a good amount of cash in the bank that is spare at the moment, I think it's definitely worth investing, providing that you can survive for say 3 to 6 months without a salary. If you've enjoyed the video so far, please leave a comment below as to how you think the rate cut will impact the economy. Also, check out some of my other videos for further information on investing and property. How do I think the rate cut will impact on property prices? Well, firstly, property prices usually increase when there's a rate cut. This is because a rate cut makes purchasing a property more available to you and I, because it makes the mortgage cheaper on a monthly basis. If more people can afford to pay a mortgage, more people can afford to buy a property. Therefore, because of the increased number of buyers, but the stationary level of supply drives prices up. However, we could also be at risk of an increased number of sellers. Because of the uncertainty in the market and the number of businesses that are firing staff or not paying salaries because they're having to close, it could cause a lot of people to need to sell their homes to be able to afford their monthly expenses. In terms of how this will actually impact your monthly payment, firstly, if you're on a tracker rate mortgage, the drop in base rate will be passed directly onto you. Therefore, if your mortgage interest rate is currently 2% a year, it's most probably going to drop to about 1.45%. This will save you, on average, about £50 a month, depending on the size of your mortgage. If you're on a variable rate mortgage, this drop in rate could be passed to you. Because a variable rate mortgage usually follows a bank's basic interest rate and not the Bank of England base rate, the drop in rates doesn't necessarily have to be passed to you. But because of the circumstances, it's quite likely that banks will be passing on this drop in base rate. But if you're on a fixed rate mortgage, this drop in base rate isn't passed on to you. However, you can always refinance onto a different mortgage product that is probably going to be at a lower rate. However, you might have to incur early repayment charges to get yourself out of the fixed term deal. This is also quite likely to have a large impact on savings. The basic savings rate for a bank account in the UK is between 1 and 3%. Because of this 0.65% drop, it's likely that the savings rate is going to decrease to 0.45 to somewhere around 2.5%. This is going to make saving money a lot more difficult, and the interest receipts that you'll receive on your money in your bank account is going to be a lot less than it was beforehand. There's also a risk that if any of the banks do go under, that you could lose your savings. However, there are a lot better measures in place compared to 2008 to stop banks from going under, and it's also likely that the UK government would bail out the UK banks. Also, there is processes and policies in place where any amount up to £75,000 per person will be saved or secured or covered by insurance at the event of any banks going under. As such, if you do have any savings tied up in low interest rate bank accounts, it's a great time to go out into the market, make some investments in the stock market or in property or real estate. In terms of what I'd recommend for investment, I think you want to try and play it as secure as possible, because obviously there's a lot of uncertainty as to how long this illness is going to last and what impact it's going to have on businesses. An investment such as investing in like the S&P or FTSE 100 is going to be quite secure, as you know that realistically in the next 10 to 15 years, it's almost guaranteed that the price is going to improve and that every single company in the S&P 500 or FTSE 100 isn't going to go under. I'd also be very conservative and invest in very large companies such as Boeing or Coca-Cola or BP that have really stood the test of time and have been around for tens and if not hundreds of years in some instances. If you've enjoyed this video, please check out some of my other videos on investing, or subscribe to the channel and ding the notification bell so that you're alerted when I upload a new video. Cheers.